Hi, this is the answer to essential question number 1. These are the accounting ones during the spring of 2011. This is the question about the small commercial kitchen. You rent space to others that don't have space and want to try out new menus with limited seating. I'm kind of thinking like Kitchen Crew or something along those lines. Anyway, let's take question number 1. The gas bill comes in. Customer's cranking up the stoves this month. Now, you can think of this as an invoice that comes in. This is something which is an account payable. So what you have is an increase in your liabilities. It's not balanced off by anything over there, so it's got to balance off someplace else. You should be looking at right there is owner equity goes down too at the same time, so your balance sheet balance. No cash is necessarily flying around on this one, so we should be okay. If you want to actually be a little bit more complete, you can think of it as that you've had an increase in expenses, and then have a decrease in cash from operations, and then also follow it up with an increase in cash from finance. This is like a more complete way, but like there's a whole bunch of right answers that are going to be floating around through there that are totally acceptable. 2, all the tonight's clients pay for the space they rented. You collect cash for it, so operating revenue increases, flows down to increase in net income, which results in an increase in cash from operations. So that one worked out fairly easily. 3, there is one client you have to bill once a month. They are canning for markets. You just send out the invoice. So what you have here is a increase in asset, which is going to be your accounts receivable, and at the same time you're going to have a increase in owner equity. And that should be it right there. You can also, again, if you want to follow around a more complicated path, is go ahead and have an increase in operating revenue, and that is going to go ahead and make cash from operations go up, and then have a decrease in cash from finance. But again, there's a lot of flexibility on this particular question. You need to refill propane tanks and a liquid nitrogen tank. You know what you need the propane for. Liquid nitrogen is for like cool things like ice cream in a minute and a half. So what you're doing here is you are increasing your inventory and decreasing your cash. Those are both assets and they balance each other out. And you have a decrease in cash from investments. That's where we're dealing with the working capital. 5, time to expand the refrigerator, looking to do with cash on hand. Exact same pattern as question 4, except you're dealing with a fixed asset instead of a current asset. So you have an increase in fixed assets, a decrease in cash, and what you're going to have then is a decrease in cash from investments over on the cash flow statement. 6, donate kitchen space to some nonprofit groups raising money for breast cancer. Technically, this doesn't do anything. You could possibly go ahead and say that there are expenses associated with it, and so you could have an increase in operating expenses and a decrease in cash because of it. 7, there was a small leak in a water pipe. You pay to have it repaired. That's just an increase in operating expenses, which means you have a decrease in cash from operations. And 8, the business is a little short on cash this month, so you write a personal check to the business. This is an increase in cash. It is also an increase in owner equity, and it is an increase in cash from finance. And that should be the answers to essential question number 1 that we took on July 25th, 2011. Thank you.